Most people believe money evolves peacefully. Coins become paper, paper becomes plastic, plastic becomes digital, a smooth, inevitable progression. That belief is wrong. Money has never changed without conflict. Every major transformation in how humans store value has ended one era of power and elevated another. And every time, the fight was hidden until it was already over. Today, we are told that cryptocurrency is just another asset, a speculative playground, a volatile toy for traders. But beneath that surface narrative, something far more dangerous is unfolding. Because for the first time in modern history, money itself has escaped the monopoly of the state. And the institutions that built their power on controlling money are not reacting with curiosity. They are reacting with fear. What you're witnessing is not a debate about technology, is not about Bitcoin prices or blockchain jargon. It is the early stage of a war over who controls value, trust, and obedience in the 21st century. And history tells us exactly how these wars end. For most of civilization, money was physical: gold, silver, land, grain. Value existed outside rulers. Kings could tax it. Armies could seize it. But no one could create it from nothing. That limitation mattered, because power has always been constrained by what it can extract. The turning point came when governments discovered they could replace physical scarcity with legal authority. Paper money was not backed by trust at first, it was backed by violence. Laws forced people to accept it, armies enforced it, taxes demanded it. But even then, there were limits. Gold standards, silver ratios, convertibility promises, those limits collapsed in the 20th century. Wars became too expensive. Empires needed unlimited funding. And the final tie between money and physical reality snapped in 1971, when the United States quietly ended the gold standard. From that moment on, money became a promise backed by nothing but confidence, and confidence could be managed. Central banks emerged as the new architects of reality. They controlled interest rates. They expanded money supply. They stabilized crashes by creating liquidity from thin air. They told the public this was necessary. And for decades, it worked. Not because the system was sound, but because there was no alternative. Every currency depended on another currency. Every bank depended on another bank. Every country depended on debt. The system was fragile, but closed. Until 2008, when the global financial system collapsed under its own leverage, the illusion broke briefly. Banks were rescued. Losses were socialized. Money was printed at historic levels. And for the first time, ordinary people noticed something unsettling. The rules were different for different players. If you failed, you were reckless. If banks failed, they were systemic. Trust eroded, quietly, unevenly, but permanently. And then, in the shadow of that collapse, a document appeared online, written by an unknown author. No credentials, no institution, no backing, just code. Bitcoin was not created as an investment. It was created as a response, a reaction to a system that had lost moral credibility, a form of money that required no permission, no central authority, no bailout. At first, it was ignored, then it was mocked, then it was tolerated, and then it became dangerous. Because Bitcoin solved a problem governments assumed was unsolvable: digital scarcity. For the first time, value could be transferred globally without a bank, without approval, without intermediaries. And once that door opened, it never closed again. Cryptocurrency evolved. Ethereum introduced programmable money. Stablecoins created digital dollars outside the banking system. Decentralized finance replicated lending, borrowing, and trading without institutions. Each innovation chipped away at something central banks rely on: relevance. The rise of crypto was not explosive at first. It was gradual, almost polite. But beneath the surface, it was changing expectations. People began asking questions they were never meant to ask. Why does money lose value every year? Why can governments borrow endlessly? Why are savings punished while debt is rewarded? Crypto didn't answer all of those questions, but it revealed that alternatives were possible. And that realization triggered the next phase. Central banks did not declare war immediately. They never do. Instead, they studied, they observed, they experimented. Then they responded. Digital currencies were introduced as modernization, efficiency, inclusion, progress. But CBDCs are not crypto. They are the opposite. Where crypto removes intermediaries, CBDCs centralize them. Where crypto limits supply, CBDCs expand it. Where crypto allows anonymity, CBDCs enable total traceability. In a CBDC system, money can be programmed, spent only on approved goods, frozen instantly, expired if unused. This is not speculation. It is openly discussed in policy papers. From the perspective of a central bank, this is not control, it is stability. From the perspective of a citizen, it is conditional freedom. And this is where the conflict becomes unavoidable. Because crypto does not require trust in institutions. CBDCs demand it. Crypto operates outside borders. CBDCs reinforce them. Crypto is opt-in by design. CBDCs become mandatory by convenience. This is not a technological disagreement. It is a philosophical one. And history shows that when systems of power face alternatives they cannot dominate, they respond with pressure. Regulation intensifies. On-ramps are restricted. Exchanges are monitored. Tax rules become punitive. Narratives shift. Crypto is framed as dangerous, criminal, destabilizing, not because it is uncontrollable, but because it is uncontrollable by them. At the same time, central banks are trapped. They cannot raise rates too high without collapsing debt markets. They cannot stop printing without triggering defaults. They cannot abandon control without undermining their authority, so they attempt both at once. They suppress crypto while mimicking its benefits. They warn against decentralization while building digital currencies. They claim innovation while preserving hierarchy. This contradiction is the breaking point. Because systems built on control cannot coexist with systems built on permissionless access indefinitely. One will absorb the other, or one will collapse. We are already seeing the fractures. Banking crises accelerate crypto adoption. Capital controls push wealth into digital assets. Currency devaluations drive demand for alternatives. Every attempt to stabilize the old system strengthens the appeal of the new one. And yet, crypto itself is not immune to failure. Speculation distorts purpose. Centralization creeps in. Exchanges become banks in disguise. Leverage returns. The war is not between good and evil. It is between two imperfect systems competing for legitimacy, and the public is caught in between. Governments cannot openly ban crypto without revealing insecurity. Crypto cannot replace fiat overnight without chaos. So the conflict unfolds slowly, bureaucratically, legally, psychologically. A war of narratives: who defines safety, who defines legitimacy, who defines money. History suggests the outcome will not be clean. In previous transitions, power never disappeared. It shifted. New elites emerged. New rules replaced old ones. The architecture changed, but hierarchy remained. Crypto will not destroy central banks. Central banks will not destroy crypto. But one will shape the other. So the most likely future is hybrid. A world where decentralized assets coexist with centralized digital currencies. Where freedom exists, but only for those who understand the system. Where surveillance increases, but resistance adapts. The real divide will not be technological. It will be educational. Those who understand how money works will navigate the system. Those who don't will live inside it. And that has always been the pattern. So what does this mean for you? First, it means this conflict is not about prices, it is about power. Watching charts without understanding the system misses the point entirely. Second, it means monetary freedom is not guaranteed by technology alone. It requires awareness, discipline, and restraint. Tools do not protect people. Knowledge does. Third, it means the future of money will not be decided by votes or white papers. It will be decided by incentives. Whichever system aligns survival with stability will endure. The coming war between crypto and central banks will not end in headlines. It will end quietly. Through defaults, regulations, crises, and reforms. And by the time the outcome is obvious, the choices will already be limited. That is how monetary history works. If this perspective challenged how you think about money, power, and control, share your thoughts in the comments. And if you want more deep financial history that cuts through surface narratives, subscribe to the Fiscal Archivist, because the most important battles are never announced.